You drive past them every day. The dark windows, the empty parking lots, the large faded rectangles on the sides of buildings where illuminated corporate logos used to be. For the average American, the local strip mall or shopping center is a fixture of daily economic life. It is where you buy your groceries, your clothes, your medication, and your household essentials. But right now, those community hubs are being hollowed out at an alarming rate. Recently, a wave of permanent closures has wiped out 645 retail locations across North America. When a massive chain packs up and abandons your town, it does not just mean you have to drive a few extra miles to buy what you need. It means the foundational economics of your community are fracturing. Jobs vanish, local tax revenues drop, and the economic stability of the neighborhood takes a permanent hit. The mainstream media has a very simple explanation for this sudden wave of closures. They call it the natural evolution of the consumer. They tell you that these 645 stores closed simply because everyone is buying their goods online. They point back to the years between 2017 and 2019, the era of the so-called Amazon effect, and claim we are just seeing the final stages of that digital transition. But that narrative is fundamentally outdated. It is a convenient excuse used to mask a much darker structural reality. We are not watching a simple shift in consumer preference. We are watching Retail Apocalypse 2.0, and this time, these stores are not being killed by the internet. They are being crushed by the sheer cost of existing in the physical world. To understand why these stores are vanishing, we have to look at the exact pressures destroying their profit margins. The first fatal pressure comes from the supply chain, specifically the cost of energy. As we uncovered in our previous investigations into the domestic energy market, the American refining sector has lost approximately 800,000 barrels of daily processing capacity. This bottleneck has kept the wholesale price of diesel fuel artificially and permanently high. A brick-and-mortar retail store is completely dependent on continuous, physical deliveries. Every single item on a shelf arrived on a heavy-duty truck burning expensive diesel. When the cost of moving goods skyrockets, the retailer is forced to absorb that penalty. In a healthy economy, they would simply pass that freight cost on to you, the consumer, by raising prices at the register. But there is a mathematical limit to what families can afford. When inflation-weary shoppers reach their breaking point and pull back on spending, the retailer's profit margin vanishes completely. The high cost of fuel does not just make your commute more expensive. It actively bankrupts the stores you rely on for basic goods. But high diesel prices are only the first blow. The second pressure point is bleeding these companies from the inside out. In the retail industry, inventory loss and organized theft are categorized under a single, sterile term: shrink. For decades, shrink was considered a minor, manageable nuisance. It was just a fractional cost of doing business. That is no longer the case. According to the National Retail Federation, shrink accounted for over $112 billion in industry losses annually leading up to this current crisis. To put that rapid escalation in perspective, that number was $94 billion just a few years prior in 2021. The Vice President of Asset Protection at the National Retail Federation issued a clear warning regarding this trend, stating that retail crime and theft continue to impact the industry at unprecedented levels, noting that it is no longer just a financial loss, but a fundamental safety issue. Retail crime has escalated from a localized annoyance to a primary driver of corporate liquidations. When $112 billion in inventory walks out the front door, the economic damage multiplies rapidly. The immediate loss of the product is devastating, but the secondary effect is what actually forces the store to close. As crime and inventory loss rise in specific zip codes, the property and liability insurance premiums for those retail locations skyrocket. The store is caught in a mathematical trap. They are losing physical goods from the shelves, paying massive insurance premiums just to keep their policies active, and paying inflated freight costs just to restock the stolen items. No business model can survive that level of sustained financial bleeding. Ultimately, the math stops working. The operating costs vastly exceed the revenue. The corporate office makes the only decision it can. They order the store to close. The signs come down, the doors are locked, and 645 locations go dark. For the average citizen, the immediate impact is a loss of convenience, higher prices at the stores that remain open, and a reduction in local jobs. But the true danger of these closures is not about where you buy your shoes or your groceries. The real threat is what happens to the physical building left behind. When a massive corporate tenant breaks their lease and stops paying rent, a financial time bomb is activated, and as we are about to see, the people on the hook for that multi-trillion-dollar disaster are not the retail executives. They are your local bankers. When the doors lock and the corporate signs are stripped from the facades of these 645 locations, a massive physical footprint is left behind. The mainstream media often suggests a simple, optimistic solution to this problem. Simply convert these empty buildings into affordable housing or modern fulfillment warehouses. It sounds like a logical fix to the local housing crisis and the e-commerce boom. But in the physical economy, repurposing commercial real estate is incredibly difficult and intensely expensive. Strict local zoning laws strictly limit what can be built in these commercial corridors. Furthermore, the sheer cost of retrofitting an abandoned big-box store, or a local pharmacy, with residential plumbing, separate air conditioning systems, and strict safety compliance, is financially impossible for most property owners. Because they cannot be easily repurposed, these buildings become zombie malls. They sit entirely empty, providing zero value or services to the surrounding community. But just because a building is empty does not mean the expenses stop. The landlord who owns that strip mall is still legally obligated to pay local property taxes. They must still pay for basic structural maintenance, and increasingly, they must pay high premiums for private security to prevent the empty structure from being vandalized or destroyed. The building is actively hemorrhaging cash, but because the corporate retail tenant has broken their lease and fled, zero revenue is coming in the front door. This brings us to the most dangerous pressure point in the modern economy: the commercial real estate maturity wall. When you look at the tracking data provided by organizations like TREP and Bloomberg, a terrifying timeline emerges. Between the years 2024 and 2026, an estimated $1.5 trillion to $2 trillion in commercial real estate debt is scheduled to mature. This is a massive, concentrated block of debt across the entire country that is all coming due at the exact same time. To understand why this is a crisis, we have to look at when this money was originally borrowed. During the cheap money era of 2020 and 2021, retail landlords locked in their commercial mortgages at historically low interest rates. At the time, with a national retail tenant paying steady monthly rent, the math worked perfectly. But commercial mortgages do not last for 30 years like a standard residential home loan. They operate on much shorter terms, requiring a massive balloon payment or a complete refinancing at the end of the loan cycle. Now, the bill has arrived. The landlords of these 645 shuttered locations must go back to their lenders to refinance their buildings. But the economic environment has completely inverted. First, they no longer have a tenant generating rent, which fundamentally destroys the value of the property itself. Second, the aggressive rate hike cycle initiated by the Federal Reserve between early 2022 and late 2023 dramatically increased the cost of capital. These landlords are being forced to refinance empty, depreciating buildings at a significantly higher interest rate. It is a mathematical equation that guarantees insolvency. The property owner simply cannot afford to keep the building. When a landlord cannot refinance and cannot pay the mortgage, the logical next step is foreclosure. They hand the keys back to the bank. But right now, the banks are doing everything in their power to avoid taking those keys. If a bank officially forecloses on an empty strip mall, they are legally forced to recognize a massive loss on their official balance sheet because the building is now worth a fraction of the original loan. To hide these losses, banks have been offering landlords short-term loan extensions, a desperate financial strategy that industry insiders call extend and pretend, or delay and pray. They are simply pushing the massive losses a few months down the road, hoping the economic environment miraculously improves. But time is a finite resource, and the extensions are running out. Real estate analysts are issuing clear warnings that the wall of maturities is here. Properties that were financed in a low-rate environment are now crashing into a completely different economic reality. The landlords are officially defaulting, and the trillion-dollar losses are being transferred directly onto the ledgers of the banking sector. As the crisis shifts from the empty retail shelves into the bank vaults, the economic pressure escalates. And as we will see in Part 3, the financial institutions holding the bag on these dead shopping centers are not the massive Wall Street titans, but the local banks that dictate the survival of your community. When the general public hears the phrase banking crisis, they immediately picture the massive, towering institutions of Wall Street. They imagine multinational giants absorbing the blow of a financial collapse. But when it comes to the implosion of physical retail, that image is a complete misconception. The massive Wall Street banks are highly diversified. They saw the retail apocalypse coming, and they limited their exposure. The financial entities actually holding the bag on this multi-trillion-dollar debt are the local and regional banks. According to data from the Federal Reserve and the FDIC, regional and community banks hold roughly 70% of all commercial real estate loans in the United States. These are the mid-sized institutions that operate in your state, sponsor your local events, and hold the checking accounts for your neighborhood businesses. They are the ones who loaned millions of dollars to the landlords of those 645 shuttered retail locations. And now, as those landlords default and walk away from their empty buildings, the regional banks are being forced to absorb catastrophic losses. They are suddenly the reluctant owners of massive, depreciating zombie malls that generate zero income. We saw early tremors of regional bank instability in the spring of 2023, but the sheer mathematical weight of the commercial real estate maturity wall, hitting between 2024 and 2026, is an entirely different magnitude of crisis. When a regional bank is suddenly forced to absorb massive losses on empty retail centers, they have to initiate emergency survival protocols. To protect their remaining capital, they must instantly stop lending money. In economics, This is known as a credit crunch. And this is exactly where the corporate retail apocalypse crashes directly into your personal cost of living. Ask yourself, who relies on loans from a regional or community bank? It is not the massive tech conglomerates. It is the local family-owned construction company that needs capital to buy a new bulldozer. It is the neighborhood mechanic trying to expand his garage. It is the local bakery trying to make payroll during a slow month. And it is the young couple trying to secure a mortgage for their first home. When the local bank freezes its lending to survive the collapse of the strip mall down the street, the financial blood supply to the entire community is cut off. The local businesses cannot expand, which means they cannot hire new employees. Without access to credit, smaller businesses are forced to close their doors, leading to further job losses and an even deeper reduction in local tax revenue. The crisis acts as an economic contagion, spreading from the empty corporate retail shell into the very foundation of Main Street. This brings us to the ultimate question. When 645 retail locations vanish overnight, who is actually paying the bill? It is not the corporate executives who signed the closure orders. They have already liquidated the assets and moved on. The people paying the bill are the local citizens. You pay for it through the decay of your neighborhood, the loss of local employment, and the systematic freezing of the credit you need to build your own life. The mainstream narrative wants you to believe that a boarded-up storefront is simply the result of people choosing to buy their shoes on the internet. But the data tells a much more severe story. It is the result of an unsustainable matrix of high energy costs, unchecked inventory loss, and a frozen commercial credit market. A dark, empty big box store is not just a sign of changing consumer habits. It is the very visible symptom of a localized banking crisis. Thank you for watching this investigation. If you want to understand the hidden mechanics driving the economy, the banking sector, and your cost of living, subscribe to the Cost Pressure Report. We will continue to follow the data.